Well, good evening and welcome to this live stream on the 31st of January 2023. Can't believe January's already got to the end of the month. What's happened? Martin North from Digital Finance Analytics here. Great to have you on this evening. And we're going to have a very interesting explore of the financial markets and what's going on and what might be going on and how that translates into investment strategies and portfolios and all those things, which are actually pretty important to discuss at the moment. Before I bring Damien, I will just, as normal, remind you we don't give specific financial or legal advice. This is a general conversation only. We do moderate the chat, so just bear that in mind, but I do encourage you to share your thoughts and opinions. And, part of the fun is seeing what's going on in the chat, so feel free to participate. This is as at the 31st of January if you're watching on replay. If you'd like to ask a question or get my attention, if you use that Walk the World, I'll make sure that I see it in my question queue. And that's a much greater probability than getting spotted because quite often the chat gets quite busy. I've also enabled Super Chat, which means that you can get your question on top of the list if you want to do that, or indeed make a contribution to what we do here. Always greatly appreciated. Right, let me now bring Damien in. Hello there. How are you doing?
Yourself, Martin?
Yeah, pretty good. I can't believe it's into January already. We've had 1/12 of the year. Can you believe it?
I know. January in Australia doesn't really feel like a real month, though, does it? It's sort of not until kids go back to school, which was today, I believe, for most people. So I feel that sort of, for a lot, that sort of marks the end of the rolling sets of people away on holidays and sort of starts the year in earnest.
Well, you can certainly tell it was a difference because the traffic jams were back today. Lots of people being ferried to and from school. And generally back to the standard mayhem. So I think you're right, it's over. But it is interesting because, of course, we do have the very different dynamic compared with the Northern Hemisphere, where people tend to come back more quickly. And in fact, January generally can be quite a strong month in the markets. I guess that's partly to do with tax, end of the year. People actually have money to put back in the markets. I guess it's also about end of year performance and how that, trying to make sure that they maximize their performance as best they can. And also, I guess the prospect is, well, last year was so bad, it can't be as bad this year, it must be better. So there are some reasons why January often is a little bit more positive, at least initially.
Yeah, that's right. And I think the other one, I think Grantham sort of pushes it often is there's a presidential cycle effect, and I can't remember which one it is, but it's something like the second or third year or something like that, and we're right in the middle of that phase at the moment as well, which is there's like a 6 or 7 month period that basically gives you all the returns from over that presidential cycle, and so if you with the, I guess all these come with a disclaimer as saying, well, there's a tendency, but there's no promises.
So no absolute correlation. But Grantham's interesting, right? Because he came out with yet another missive right at the start of the year and said, "Yep, this is still a super bubble. We haven't actually seen it work through yet. There's more downside risk ahead." And in fact, Morgan Stanley, Wilson from Morgan Stanley, came out today. And said basically, it's don't fight the Fed. Bears are going to actually find the markets are up, but they're going to come back down again. So it's either a bear trap or a bull trap, depending on how you look at it. And they're arguing, of course, that the market valuations in the US are actually coming in terms of the results lower than their original base case. So they're actually now down forecasting the returns, and that, of course, means that the market values, particularly in the US, are probably a bit high.
Yeah, so, and it's worth just reminding people, I guess, how I look at earnings, because earnings are, forecast earnings may not be what you think they are. So really this first year of forecasts, and in the US, there's this huge focus on the next quarter. It really comes from the company. It's not something which, so while it's an analyst number, the companies massage and they talk to the analysts about Anyone who's too far outside the range, they'll be on the phone literally to you saying, oh, so everyone else is expecting whatever $1 worth of earnings, and you're saying it's $1.10, and that seems really high. And why do you think it's going to be there like that? And we'll literally talk analysts down from it's not a direct change in numbers, but it's I distinctly remember one CEO coming out and saying, well, to a colleague of mine, about, oh, wow, that's a hairy-chested call. He called it for the earnings. You've really gone out on a limb there. And the guy brought his numbers back in, and they actually came in with basically exactly the number he said, but which was 20% above what everyone else was expecting. But he got talked down to because they wanted to come out with a surprise on the day. So there's one part of it from that it comes very much from the companies. And then where do the companies get it from? Well, most of them get it from their salespeople and sort of the people on the line. And those are the people who, when they ask, what do you think you're going to do next quarter? They look at their book, or they look at what they did in the last quarter, and that's what the expectation is. There's not a lot of interest rates have just shot up by a record amount, and and inflation's starting to fall away, and they're not macroeconomists, and so usually the company forecasts are very good at letting you know where things are going until you hit these turning points when they become actually very bad and lagging.
Yes.
And so, are we at a turning point? Like that's the big question. At each step when you're looking at analyst numbers, you go, well, if you're at a turning point, you can't trust them as much. So what are analyst numbers saying? They've certainly come down. I sort of, I guess, facetiously in some way, I talk about it being the 10% number. That's next year, everyone expects 10%. That's roughly where analyst forecasts start all the time. And so the aggregate's 10% for the whole market, and then it cuts one way or the other. It either goes up or down, and eventually ends up where it sits. So it started there, a bit above 10% this time, and we're down to 2.5 for this is for the 2023 numbers. Having said that, though, the fourth quarter numbers are already negative. So we're already looking at about a loss of about 1.5% so far. Could be more. We'll see once the whole thing comes through. Probably, I'd expect it'll keep going, falling away. And so effectively, what analysts are saying is the worst is behind us. It's already happened. Don't worry about it. It's happy days from here, and I think that's optimistic at best. That's.
What about the Fed? Because the Fed and the markets are, disconnected is a polite way of putting it, right? Because the Fed is still saying we've got to put rates up more. We haven't got inflation under control. There's more we have to do. And even Bank of Canada, who moved the rate up and then said, but it will be high for a long period of time now. Hopefully, we'll have to increase it further. But the markets are saying no. By the middle of the year, the Fed's going to be dropping rates. It's a fundamental disconnect, isn't it?
There is. I must admit, I've sort of I have some sympathy with the markets. I think the Fed's done too much, and it'll work that out later on in the year. And I don't know if it'll be cutting by mid-year, but I think it'll be wishing it by the end of the year. It'll be wishing it had, I guess, is my thought, because they generally don't tend to move that quickly in terms of they don't do 180s that quickly. I think they tend to sort of like to drag that out a bit. But so I think there's certainly that disconnect, and the other disconnect, which I think is unnerving the Fed as well. There's this whole reflexivity argument, because the Fed have this thing they call financial conditions, and that's what they want. And one of the inputs into financial conditions is equity prices, and so they want financial conditions to be tight. And because equity prices are so high, then they're loose, and so therefore the Fed should keep rates higher for longer. And so it's sort of this bit about the equity market goes, oh, they're going to lower rates, therefore we can increase. We'll go and buy lots of stuff and push prices up. And the Fed goes, well, you've just pushed prices up, so therefore I need to put interest rates up more and bring it back again. So yeah.
And there's another factor just to bear in mind as well. Of course, the Fed is doing quantitative tightening a little bit, but the US Treasury has been actually putting more liquidity into the market. One of the reasons why they've got this, debts ceiling problem emerging now. So it's almost like you've got a shadow Fed over there doing something different to the main Fed.
Yeah. There's certainly. And then that'll probably blow up into issues. And I don't know. I really dislike the whole idea that the politicians basically say, effectively to me, what they're doing with the debt ceiling is they're saying, well, you're allowed to, we're saying what the revenue is going to be. We're saying what the costs are going to be, and then we're saying what the profit. Then we're going to saying what the profit should be. But the profit actually is different to the revenues and the costs, and so therefore we're not going to do. We're not going to let you borrow any more money. And it's like, so just a minute, you've got A plus B equals C. You're telling me what A is, you're telling me what B is, and you're telling me what C is, and C doesn't equal A plus B. So, it's your fault, not somebody else's fault. So,
yeah. Anyway. So I guess what we're trying to do is highlight that the market and the Fed and the US Treasury are all sort of a bit jumbled up, but it's worth also saying that what the Fed does has a significant ramification, not just for the US market, but for all markets, and of course the Australian market too.
Yeah, absolutely. And I think as well, given that they've sort of led the world into this inflationary boom, is the expectation is they'll be the ones to lead the world out of it, and I think that's a reasonable expectation to have. There's working at what the US consumer is doing is pretty core to any sort of strategic sort of view, and I guess macro view of the market is sort of working out that part first, and then sort of extrapolating out, because in the end, if the US consumer is pulling back and not spending, then it really doesn't matter what's happening in Australia. That's going to flow through the rest of the world, or the US consumers out there spending madly and taking on all extra debt, then Europe's a bit of a sideshow, and that whatever that happens, it will sort of infect the rest of the world with that. So yeah, and so I'll follow on this earnings thought. So we're sitting in this part with this earnings, and as I think Grantham as well, sort of, he's got a lot of good things to say on this, but it's the idea that, okay, can we go through a 6 or 12 month period where we actually get a reasonable kick on over the next 6-12 months, and you can sort of go through some reasons and go, well, maybe oil prices come down and consumers save a bit of money, and they take that money and they go and spend it elsewhere, and that sort of helps the rest of that economy tick along. Maybe there's food prices look like they're starting to come down. Some of the housing costs in the US have started to turn down. Maybe there's a number of things you can sort of point to that mean that'll sort of cushion the blow, and it all ends up being this nice, smooth, soft landing. I don't think that's the case. That this will be, if it is a soft landing, it'll be like the first one they've stuck in, God knows how many times. But there's certainly reasons you can see that there's a potential path to that. It just doesn't look like a likely path. So really, this focus right now on earnings is for me is pretty key. Like, this reporting season is going to be. We're part of the way into it, but is really giving some good guidelines on what's going to happen for the rest of the year, and that follow through. Because if earnings fall away another 20%, which a number of sort of market models sort of looking at forward indicators suggest they should, then markets are going to be down quite significantly. Yeah. I'd think a lot more than 20%. If they manage to stick where they are or fall to zero, and muddle through on other positive effects and other things going on, that they managed to, and maybe it's that inflation's falling, but companies have done a pretty good job so far of raising their revenues higher than what they've been raising their costs, and hold on to some more margin, then maybe the markets are all right where they are. I think there's probably more downside risk. I don't know if I'm quite on the whole, earnings going to fall 20% just yet. I do think there's enough doubt, but I'm at least halfway there in terms of thinking there's at least 10% more downside to earnings numbers, quite possibly 15. So,
and Morgan Stanley again, they're saying some similar things, that if you start looking at the results so far, they're underperforming quite considerably. And it's quite consistent across a broad range of industry sectors. So it's not just one or two. In the round, there's enough downside risk here to suggest that the markets are probably overvalued at the moment and will need to come back quite a bit. And, I'm probably on the same page as well. It doesn't seem to me plausible that with consumers, experiencing higher interest rates and low levels of confidence and all those things, that they're going to get us out of jail. The only question, I suppose, is whether, in fact, the China situation has enough impact. And, in fact, Cookie Boy said, thoughts about China reopening, is it inflationary? How does it, flow through? I mean, that's a really good question, isn't it? Because you can make two arguments. One is that China reopening is going to create a whole lot of disruption, and therefore you might find that demand for some commodities will go up. But on the other hand, we know that we've got the demographic shift in China. We know that there's a whole bunch of issues. We know we've got property prices down. We've got a lot of spare property. So China itself could be part of the problem rather than part of the solution, and China reopening might not be the get out of jail card. And yet some people in the markets are sort of pretty much, to my mind, banking on that being the counter argument for all the negativity.
Yeah. Okay. I was going to say when you started talking, I was saying let's leave China to later, but I think you're right. It's a good entry point. But I just want to warn people we're about to go down a rabbit hole for the next 20 minutes, and we'll come back to earnings after that. But let's put a pin in. We won't forget the earnings.
Yeah. That's good. Okay. Let's come back. But in a way, China is such a critical issue relating to where earnings come.
Yeah, that's right. Well, for Australia more so than the US, right. I guess is where that, and for Australia and to a certain extent Europe. So Europe's a pretty big exporter and importer. Lots of trade relationship with China. So you do really notice the effect. Okay, so the first thing I want to say is there's a lot of data coming out right now from China, and I just want to caution everyone to take that data with lots of salt. There's they're going through this reopening. There is various places where there are people very sick and people not doing things because of so many people are sick. But on the flip side there is some reopening and travel and things like this are really kicking off, and so and there is some normalization in other areas. I guess what it is that there's enough data that's weird right now that I'd just be cautious. And the other thing to remember is a lot of China data as well, they actually add the first 2 months of the year together. So they actually don't come out with a set of data. So we're seeing all the data for December at the moment, but we're actually going to miss a month of data. And then they come in and then they go, okay, here's what's happened for January and February together. And so, so with all that sort of put together, I feel as if I don't really know what's going on in China from looking at the data, and I think it's going to be 2 or 3 months at least before we can really work out what is right and what's not. But that having said, we spoke. We'll start with the demographics because we spoke about that last time, and then they came out and they were worse than what was spoken about. So I might just let me bring that chart up actually.
You'll need to share your screen first, and then I can put it on the screen here. Yep. Okay.
Got that? Yeah. Okay. So I've got a chart up here. Now the blue line is the actual data, and then I've got these sort of two different paths. Now you can see that sort of flattened out blue bit, and now there's something there is COVID effects in there. And the real question is how much there is. So this is an urbanisation rate. And so the idea is that, you start with less than 20% and then you start putting more and more people into cities. And at some point you're going to cap out. Now the question is, where does this line cap out? I've been, I think, pretty friendly to the US, to China and said that sort of by the 2040s, they're capping out around about 80%. Now, that's a level similar to Japan, Korea, the US. There's plenty of other countries that sort of cap out, 70s and 75s, which would, give you a much lower trajectory. But, let's be friendly on that part because, I don't need to make too many assumptions on that part to show how bad the demographics look. So we just had this recent set of data come out. Now, this is the percentage of population moving into cities. And so we can see it sort of rose and you're running at about 1.4% prior to this. There's a whole flattened period out because the data is all a bit weird. It dropped in 2021 to 0.8 and then dropped last year to 0.5. Now, I've sort of got those two scenarios I was talking about. One I call the sort of sudden stop scenario, where basically they try and move as many people in the cities as they can, and until they just can't anymore. And that's that. So it jumps back to 1.5% and then fades away. And then the other one is the gradual change, which says, well, maybe they go back to sort of 1.2-ish, and that just gradually fades away till they get to the end, which is what a more typical example. But then maybe as well, like I've been pretty generous in saying this is going to jump back straight away. Maybe we've got another couple of years of people sort of being a bit, I guess, shell shocked by this whole pandemic, and particularly in China, about saying, well, if you're living in the country, okay, yes, I can move to the city and I can get a manufacturing job, but maybe I get locked into the factory, and if there's another pandemic, or maybe I'm away from my, I've got these stories of people who are locked in their apartments and not getting food, and I don't have any of my relatives nearby, and maybe you find that this doesn't bounce back as fast. And so what does that mean? So you've got these two scenarios. So this is what we've been through for the last, I've sort of broken this up into 5-year chunks. So for the 2013 to 2017, I think it's about 125 million people, maybe a little bit less, moved into cities. For the last 5 years, that's fallen below 100 million. Now, if we go back to that sudden stop where they basically foot to the floor and gun it for as long as they can, you're still, you're below where you were for the last, more than the last decade. Those sort of golden years of 2003 to 2007, you're still well below that. And if you go more to a sort of a gradual one, well, now we're back to the urbanisation rates we didn't see for 20 years. So that's your two different paths for urbanisation. Neither one of them is anywhere near this other peak, and that sort of then overlays that with these residential floor starts, where this is the number of millions of square meters of residential building that's going on. Now, I'll scroll back to this one for a minute. I just want to highlight that, so where we were in let's say 1998 to 2002 was sort of, 80 odd million people moving into cities, roughly what we had for the last 5 years. The difference is for the last 5 years, there's been like 1.6 million square meters started. Back in that other one, we're back at that 200 million. Like it was just, it's just a factor of 8 times higher, or maybe 8 times, but at least sort of 5 or 6 times higher than where it was. There has just been so much building done in this part here that one part you might look at this line and just go, oh, look, it's fallen by housing starts have fallen by almost 50%. Surely that'll bounce back and iron ore will be come away, and that's what markets have been pricing in is this will bounce back and happy days for mining stocks. But in terms of just the number of people that are moving into cities, we're back to the same levels we saw early 2000s. They could fall by another 50%, and you'd still and that and you still got this big overhang of all these ones you built over the last 5 years. I don't know. It's I'm not sure how to. It looks optimistic to assume that that China is going to save the world as they reopen.
Yeah, absolutely. And you're right also about the data itself may not have a huge amount of integrity to it as well, which is another problem, particularly at the moment.
Absolutely. I mean, the demographic data is quite possibly still overstated.
Yeah. Absolutely. But what it does mean is that you've got this overhang of vacant properties. So there's a lot of stuff. It's like 22 million properties, I think was the last number I saw. That could be out of date.
I've seen numbers that said 60 odd million.
Yeah. I mean, it's a huge number. And so are they going to go on building more for the sake of building more? And I suppose more broadly, it goes back to the broader question of, well, are they going to build more infrastructure again? Are they going to put more roads and rail and all those things? Because that keeps people busy. But there is a very strong sort of direction change, it looks to me, and that is China is now talking about wanting to get consumers to actually consume more. So rather than an infrastructure strategy, it's a consumer strategy. And of course, if consumer strategy is not going to work if demographics actually works against it.
Yeah, it's going to be harder. Look, I guess the part the bit that troubles me with this is they've been saying this for a decade or more. Yes, they need to convert, and the reality is the Chinese households consume less. I think the stat is less of the total GDP than any country's ever had, type thing, in terms of the I have to get the Michael Pettis one. Actually, don't fully quote me on that, but it's definitely in terms of modern societies. I'm sure you could find a historical one that didn't. But yeah, the skew between what goes into the industrial side and how much support they get versus the consumer and how much capex is going on versus the household is at levels you just haven't seen before in modern economies.
Yep.
And so effectively, that's the part about saying, okay, well, and it was great 20 years ago, 30 years ago, where you basically said to all your households, okay, Martin, you earned $1,000 last year. You're gonna have to tighten your belt, and you're only going to earn $800 next year. But I'm going to take that $200. I'm going to invest it in all this great infrastructure and all these factories and things like that, and we're going to grow that 800 really quickly. And they were right. They grew it, so they took this big pay cut, and then they grew that 800. But what happened is they were getting sort of 20% growth, and they were saying, oh, okay, you can have 15, Martin, and we'll take another 5% and put it and invest more. And so that share just got smaller and smaller and smaller. And it was great while the growth was going, but now you've run out of that growth. And now it's all been debt. You've had to get that same growth. They've just had to add more and more debt. So what you really need policies now that actually take money from the other sector of the economy and give it to the household sector. Now, whether that means privatizing a bunch of these assets, whether it means explicit transfers, it means whatever it is, putting in. There's lots of different social things you could do in terms of better retirement and all that type of stuff like that. There's lots of different things they could do. None of it they are doing, though. Like, all the stuff that you've seen so far still goes back to saying, well, maybe we support companies a bit more. If we support companies a bit more, they'll get more jobs, and that'll eventually be useful for the people. But until we actually start seeing explicit transfers from that corporate sector across to the household sector, it's very hard to see how they can make it grow. If the whole economy is only growing at a small rate, they genuinely, if they want to get so pick a number, say it's 3 or 4% that they're going to be growing, and they want the household sector to grow at 7 or 8%, then they have to make sure that the corporate sector is not growing at all. It's growing at zero, and all the growth is going to the household sector. And when you average it out, you get your 3 or 4%. But there's no policies in place to try and do that. And in fact, the policies are about how can we get that corporate sector to grow?
And one little trick, of course, is reducing the capital that the banks have to hold, which they keep doing, right? So they're actually making the banks a little more risky by allowing them to lend even more with a lower capital ratio. So
and then you run into the problems that the whole economy is set up around the whole housing market. That housing boom we saw that went on for 20 odd years that showed that housing starts, has just built up this whole infrastructure around it where they're just reliant upon that, and that's how they've been managed to get the growth. They just keep let's go for more housing, and so they've effectively taken the red lines off. But one of the things they are doing within China is trying to centralize control. So we saw prior to Xi, there was a lot of sort of decentralization and a lot of sort of pushing more power out to the provinces. Xi's gone the opposite way, is more about centralizing control. And so the thing for me is that I do think that it's going to require, if you want to get the housing boom going again, and the housing, when I say housing boom, I'm talking housing construction boom going again, I think they're going to need to explicitly go out and tell local officials this is what the case is, because they've been out over the last few years and told them explicitly, no, you need to pull back on all this spending and 3 red lines, and housing is for speculation, housing is for living, not for speculation. Now they've taken away the words housing is for living, not for speculation, which is sort of, I guess, as you said, implying that maybe it is all right to speculate now on houses. But given the way they're trying to centralize power, I don't think that's possible. I don't think that a local government official who's just been told crack down on all these this lending. Now the words have disappeared. I don't think he's going to read deeply enough into it to go out and start trying to push all these housing and force feed the housing market until he's actually explicitly told, no, your job now is to get the housing market going again and house construction and do whatever it takes to get there. So, but the stock market's priced it as if that's what's going to happen.
Yeah. Well,
maybe it will.
I was going to say, of course, that's the point. So the markets have taken one particular view. And it's just worth reflecting, isn't it, that the household debt in China is extreme, and the concentration of property. So a lot of people have more than just one property. They have multiple investment properties, right? All leveraged across each other and all tied up in this sort of little system. All of which I don't think everybody fully understands the risks attached to that, right? So the markets seem to me to be optimistic in the extreme, and I wonder about that.
And on top of that, they've got sort of 90-odd% home ownership rate. So a lot of this is, there's a much smaller group of people. It's not like you can sort of, in Australia, you could at least go, well, if I'm going to put in these policies to build more houses and let people buy more houses, I've actually got a reasonable proportion of the population that could theoretically move into those. But there's actually not that same base in China to do this. You're relying on people having second and third houses.
Yes.
I think for me the leverage rates of consumers, if you compare it to Western countries, doesn't look as bad. But if you compare it to countries of the same size, then absolutely they look terrible.
Yep.
Yeah. And so, yes. So I think, having said that, in terms of our own portfolios, we actually did, once those announcements came, we were underweight resources. Once those announcements came, we went back to market weight resources with the view that, look, you can't stand in the way of this. The market's going to run. But there'll be a time over the next couple of months to start going back underweight resources. So we're sort of looking for that point, and at some point we will take that.
And that sort of coming back slightly towards earnings now. There are a number of people. The guy at AMP, for example, is saying in the next year or so he thinks the Australian markets will outperform the US markets, partly because of the China connection and partly because of some of the other factors that we touched on earlier. I think that's a bit optimistic personally, but they are putting a lot of eggs in the China basket again, aren't they, with regard to the local economy? Yeah. So you've got to look. It's a big step to say that there's going to be enough to drive the earnings. Like I guess, we've seen drive the earnings higher than what we're seeing already. I suppose in terms of what's come through. Sorry, I might just get before we start on so let's talk about the earnings in a minute. Actually, because I think there's two parts to this. And this was any investment story. There's always two parts to it. One is what are the earnings going to do? Are they going to go quickly, slowly, whatever? Yep. But just as importantly is what's priced in. Because if earnings are going to grow quite quickly, but they're priced in to grow really quickly, then you're saying, well, okay, well, you're not going to make any money out of that trade. Whereas if they're priced for disaster and it's just things are just going to be a little bit bad, then it's like, well, I can actually make money out of that. Even despite earnings are a little bit bad. So, but let me just do a quick fly around the world in terms of valuations. I'll share hopefully you've got that one. Sorry, Martin, I've just shared the valuation screen. Yes. Yeah. Come on.
Okay. So this is the global forward price to earnings ratio. So, there's lots of different ratios we look at, but this one's, I guess the simplest one and probably the most useful. Basically what it's doing is looking at that 12-month. So it's basically saying from today, look forward 12 months. So you've got 11 months of 2023 and 1 month of 2024, and look at the earnings that's expected and then compare that to the price. So when it gets high, the market's expensive. When it gets low, the market's cheap on this basis. So we sort of hit well over 20, sort of back in the tech boom, and then it crashed and fell back below 10 around the financial crisis. Spent a long time, 5 years down there, and then most of the time, though, it's sort of been around about that sort of 14 to 16 range. And we had this big boom over 20 again in recent times. Now, this is the global numbers. And so right now we're back at 15.9, which is slightly expensive, but really, it's nothing you sort of be too worried about. So that's the overall number. But the issue is there's lots of different things going on at different levels. Now that number has some really high earnings figures for resources companies in there, and particularly energy stocks because of the boom we've seen. So if you look at the numbers, though, excluding banks, mining, energy, insurance, so basically excluding resources and financials, and we'll look at those different areas of the market separately. Now it looks a bit more expensive. You're closing in on the 80th percentile. You're at 18 times now, and so the average is a little bit higher. But it's certainly not. You wouldn't say it's average. Now it's like borderline cheap, borderline expensive. When you look at the world x those particular sectors. If you look at Australia, it's a similar type of story. Now this is the overall market, so it's at 15.2 and close to more expensive than it has been over the recent time. So you're basically sort of saying, well, am I paying for good growth or not? And if China booms and all these stocks go, then maybe that's all right. The issue I've got, though, is actually I'll skip forward some of these ones. Is then I look at it, Australia relative to the world. So where does it usually sit? And it usually trades at about 0.95, and right now we're at 0.96. And you go, oh well, Australia's the value is roughly where it's been over the last 20 years. I'm starting from a point of maybe Australia can outperform the rest of the world. The problem with this is it's a composite of three parts. One part is the banks, the other part is the resources, and then we've got the rest of the market. And the issue we've got at the moment is banks and resources trade on low price to earnings ratios because banks, because they're so leveraged and they've got so much debt behind it, and the earnings can really swing around, especially when you go into crises. And resources because their revenue lines are so volatile that they can swing from massive profits to big losses really quickly. And so companies just over the course of time, you don't usually pay up for those. The problem for the Australian market is right now is we've actually got more banks and resources than we've just about ever had. So they're making up such a huge proportion that when you split this out to say, okay, well, Australia looks the same as the world, when you split into the three component parts, excluding banks and resources, we're sort of at the 70th percentile or something like that. So again, it's almost as expensive. Well, it's we're in the top 20 odd percent of sort of outcomes in terms of how expensive the Australian market is relative to the rest of the world. If you look at the banks, we're like well past the 90th percentile. It's basically almost never been as expensive as Australia. This is Australian banks compared to world banks. They've almost never been as expensive as they are right now. And then when you look at resources, again, they're at the 90th percentile. So the three components of the Australian market are all very expensive relative to their world counterparts. It's just that we've got lots of banks and resources which are low. So the overall market, is starting from that point. So I guess you'd have to make the argument that maybe this argument's right. I don't think it is, but maybe it is. If you make the argument that China's going to resume its property boom and it's going to shove and really get it going again back to those heights and just keep pumping up more and more properties, even though the demographics have changed. And Australian resources companies will benefit from that and grow their earnings much faster. And then that will flow into tax cuts for people, which will keep the rest of the economy going and the other sectors. Then maybe Australia's right to be priced at record highs relative to the rest of the world. The flip side is, well, we've actually got more debt than most other places. We've got got more variable mortgages than most other places, and so we're actually more vulnerable to than the rest of the world to some of these falls. And so we're starting from the most expensive we've been for a lot of these. Isn't actually a good starting point if you want to get performance out of the whole thing.
Yeah.
So we're priced for success. If it comes out at an average performance, then the Aussie market's is going to do worse than the rest of the world. We're going to have to really shoot the lights out because it's priced for some extreme success.
Yeah, and thereby hangs the problem, right? And it's interesting because the IMF just came out and they updated some of their growth forecasts, and one of them observations was that the UK is probably going to be the only economy in Europe that's going into recession this year, which is a bit of a change. But then they were reflecting again on the impact positively of China and what's going on in China, right? So they said the last month has actually given a significant change of direction. I just wonder whether people are just being a little bit too bullish on all of it at the moment.
Yeah, well, the thing is, they might be right. They might have been a change of direction, but I don't think you can tell from the stats.
No,
I don't think there's any stats out there that you basically you're guessing, and whether you think it's going to go up or you think it's going to go down, and the stats there's too much volatility in them at the moment to really sort of draw too many conclusions. So that's. I don't know what more I can say on that one.
No, absolutely right. Whilst you were chatting Jason through this question, which I think is actually quite a good question, and maybe it'll take us into a slightly different conversation, which is why would people invest in property at the moment? Prices, rents go up, but then councils and governments see that as a signal to increase rates and taxes and force more expensive associated with being a landlord with new compliance, etc., etc. I think there is a broader question here about where does property fit into this whole story, right? And it's partly an Australian question, but I think it's a broader question, because if I look around the world, we are seeing property prices beginning to ease back in the US, back in Europe, back in Australia. We're seeing...
And falling quite a bit in some countries.
Yeah.
New Zealand, Canada.
Yeah, absolutely. And we've also seen rents rise. So the rent rises are not just here in Australia, they're actually in most other countries as well. So there are some fundamental dynamics here. And the question you've got to ask yourself, with all those rate rises, the property calculus story seems to me to have changed quite dramatically.
Yeah, so I'll answer Jason's first question. Why would people invest in property at the moment? And you go, well, tax breaks is the first.
Yeah.
Probably the first thing. But the issue is you still need to make a profit. So, you can make a tax break and you go, yes, I've saved myself $5,000 because I managed to negative gear it and all that type of stuff. But, if your price of your property falls by 50,000, then the $5,000 you saved on tax won't seem as won't seem as attractive. And the $5,000 you just saved on tax was probably because you negatively geared it and lost money anyway. Probably because you lost $10,000 on that. Okay, so we are seeing global prices come back. Having said that, I guess there's a reasonable argument at the moment that they're coming. They rose sharply and now they're falling back, and so over a 2 or 3 year period, it's probably just a round trip, and that's probably right for a lot of countries. The question now though is, it's right as long as they don't keep falling, and given we've just raised interest rates and we're seeing the effects of these and recessions and other things come through, then that's where the danger lies. That it does seem as if most of the estimates of how much money got shipped out to consumers in places like the US and Australia and built up their savings is being run down quite quickly, and you're at least sort of halfway through it or further, and that pick your different bank, but a lot of them sort of suggesting that later on this year is when it's going to be running out, and so we've had this period where we just haven't seen bankruptcies and foreclosures, and all these things have disappeared for 3 years. Yeah. A lot of it due to changes in regulations, and so that's re-emerging, and I don't I think we've spoken before here, is everything is about this question about how important is the actual level and how important is a change, and they're both important, but it's I think in different markets it varies. And what I mean by that, for example, is in terms of interest rates. Our interest rates are much higher than what they were. We've had this sort of record increase in interest rates over the last year or so, and that's obviously going to hurt people as they come on. But they're lower. The actual absolute levels of interest rates are still lower than what we had in the 80s. And so, what's more important? And so, or they're even. I think they'd probably still be lower than what we had in the pre-financial crisis. And so, yeah, the absolute level does matter, but I think on terms of interest rates, the change is what matters. As more than anything, because people just get used to it. Now, when it comes to bankruptcies and all these, the foreclosures and all that type of stuff, is it the change? Is the fact we've gone from almost no bankruptcies to a more normal level of bankruptcies? Is that enough to spark more problems, or do we actually need to go past the average rate of former and actually start hitting higher levels of bankruptcies? Now, I think for bankruptcies, I'm probably slightly tilted towards the absolute level, but I do think the change matters. And so, and that's really going to be a big determinant for me about housing prices, and the effects on the rest of the economy as well is how bad that gets. Now, to date, again, with the data's really just it's come up to average. I think is basically where we are. It doesn't look terrible, but if it keeps going the way it's going, then that's where we start running into these problems. And I think it feels like the same answer I gave to the earnings. I think things are going to get a fair bit worse. I'm not positive about it, but I think you need to be prepared for things to get worse. And I guess it's diversified portfolio's and all those types of things, but it is about not wedding yourself to one path. But I think the most likely path to me would seem to be that certainly recessions and other and much weaker. And so where that leads to property, I've come a long way around that question, haven't I? What was the second part of his question again? The first part was, why would you invest in property? Oh, sorry, that's right. That's what I was getting to is we've taken off the froth. Now the question is, do we start to eat into those? And that'll be a question for how long central banks keep these rates where they are. But given the lags.
And of course, there's a subsequent question in the negative gearing stuff. Is that likely to get touched? I think probably not. I mean, the Labour Party tried and failed miserably, and it's a big impulse, particularly as interest rates rise, because effectively the negative gearing is a bigger tax offset, which means that you're actually taking a bigger chunk out of the tax take from everybody else. But I don't think anybody's going to touch it, so I think we can pretty much assume that's going to be a feature for some time to come. And the other factor that I see in my surveys is that people are saying, well, when I think about property, and particularly investing in property, I'm thinking long term. I'm thinking not just 2 or 3 years, I'm thinking 5, 10, 15 years. So in the long term, property prices might do quite well. But also, I will just make the point, Jason talked about investing in property. There's a difference, I think, between investing in property from a financial returns perspective and buying a property for somewhere to live. And actually,
a massive difference.
Actually, the problem is that many people get those two thought worlds scrambled when they are thinking about whether they're buying or not. And they are sort of almost using the wrong set of lenses to make a decision, right? Which is something that I'm pretty passionate about, because I actually think the logic is completely different if you think of it as somewhere to live rather than actually as an investment. Yeah,
absolutely. As somewhere to live, there's obviously lifestyle issues, but there's also you're about avoiding your costs of having to pay, increased rent over time, as opposed to saying, okay, now I'm actually going to try and profit from that. And the other common mistake I see is that people look at property and say, I can leverage the crap out of that. So I can buy, I can stick $1 million in, I can borrow 900,000 and, stick $100,000 in and it goes up by 100,000. I've doubled my money. And they're not paying attention to the risk side.
Yeah. The reverse is also true, right?
Exactly.
Yes.
Is that
leverage works on the way up, it works on the way down.
Yeah.
Yeah.
And so property overall is less risky than equities and other assets.
Well,
Partly because
it's less liquid though.
exactly. Yeah.
That's a really important point. And I was talking to somebody today who hadn't quite twigged just how illiquid property is. You need to find a buyer if you need to sell, right?
Yes.
You only need one
Absolutely.
buyer, but you still got to find a buyer, right?
Yeah.
Whereas
And
if you think of stocks, there's always some sort of market.
yeah, that's right. But if you've got this one asset that's got to say equities, if you let's just me talk volatility and just I guess in relative terms, bonds are sort of 4 or 5%, equities are sort of 15 to 20%, properties maybe in the 5 to 10%. But if you've just leveraged it up by 10 times, then you've gone from being less volatile than equities to way more volatile than equities in terms of the returns you're going to get. And so there's that part of it. And what you're saying about that buying, if you talk to anyone in commercial property, particularly people who look at the one I get for a lot of retail investors is often regional sort of industrial property and things like that. And you look at these ones in whatever, pick a country town of 100,000 people or 50,000 people, and you can buy this property and you might get a 10-12% yield on it, and that's great until your tenant moves out and you can't lease it for 5 years. And then you want to sell it, and actually you've got to wait for the next property boom to sell it. You basically, the joke with those ones is, you get the only time you can sell it is in a property boom. You can always, you always sell at the top of the cycle because that's the only time you can sell it. Because if you don't sell at the top of the cycle, well, you're holding on until the next cycle.
Yeah.
And so, and so the warning with a lot of those is that, you can look at some of those and go, wow, how fantastic are these yields you're getting? But you're getting those yields because of that illiquidity and because of that risk, and because, especially in regional areas, somebody moves out, you might be 5 years before you find somebody else.
Yep. Absolutely. And that really just puts the risk story in a very different perspective. And I always get a bit worried when people declare property as a safe and secure and low risk investment, right? Sometimes it is, but sometimes it isn't. And you can say this exactly the same about stocks or other investment classes too, which I suppose comes back to the fundamental question about investment portfolios, right? And I wonder how many people have an investment portfolio but don't think of the property as part of the investment portfolio. Maybe that's what they should, because maybe they've got it out of kilter. I don't know. It's an interesting asset allocation question. Yeah,
and I'm always on. I've probably spoken on this program a few times, so apologies for people that are sick of hearing me say this. But it's the people who have 6 different flavors, think they're diversified, but they've just got 6 different flavors of exposure to the Australian property market, because they've got shares which are focused on say things like Harvey Norman and the banks and stuff like that. And so, it's you're basically buying stocks that are leveraged to the housing market. You might have some hybrids and stuff like that from these same banks that are leveraged to the housing market. You have corporate debt, which may or may not have some exposure then. And then you've got your own house you're living in, and maybe you work for a bank, or maybe you work for a property developer or something like that. And you're just like, you're all in on the one trade. You need to sort of think about what are the stocks I'm buying, or the debt instruments I'm buying, or wherever it is, which ones of those are leveraged to the property market and which ones have actually got different exposure.
Absolutely. Well, let's talk about another asset class, or within the portfolio, because tech stocks have started to move quite strongly in a different direction from what we saw last year. So we saw a considerable decrease. Some of that was to do with the fact that a lot of tech doesn't make much in the way of returns at the moment, so their future value is discounted by the interest rates. As interest rates go up, their future value goes down. So the value of the property, the value of the business goes down. But we've started to see that reverse now, and we've started to see some tech companies begin to move up again. And I wonder whether that's a little bit of over-optimistic hubris with regard to what's gone on, because to my mind, nothing fundamentally has really shifted into a different gear.
Yeah, and look, I guess I'd in terms of tech, I think it's worth just highlighting there's a couple of different parts of tech, and some parts have got very stable earnings, and they're long histories, and I guess slower moving capex cycles. So let me take a stock like Cisco, for example, makes routers, And so routers, the technology really doesn't change that much from year to year. It's a sort of gradual increase, and it gets faster and more efficient and things like that. But it's not about so the people that are buying these, putting them in, and they're expecting them to last 10, 20 years, and there's not this sort of sudden flip around. Whereas at the other end, something like an Intel or an AMD coming out with the latest chips, or a Qualcomm, and if you've got the latest, fastest chip and cheaper than everyone else, then you're going to sell way more chips this year and next year, and nobody cares that Intel's been around for ages. If they're falling behind now, then they're going to lose that market. And so it's all about your latest hit. Are you as good as your latest hit? And so they're much more fast moving, and the capex cycles sort of come in quite quickly in terms of those stocks. So that's sort of two ends of that market. Then you've got the tech market, which is the the older, more stable things like your Microsofts and Googles and things like that, which are pretty well established businesses now. And then you have your sort of pointier end of it, where the companies that aren't making money and have got the next latest and greatest project, and they're losing on the current one, but they've got these projections about all this money they're going to make. Let's say it's your Uber Eats and all those DoorDash and those types of ones, where you say, okay, it's a technology type company, and it's got and so I'd be careful to look at them in different ways, because I think what we've probably seen is that, yes, they have risen sort of as a group. There's a bunch of ones in there which I think are quite have looked quite good value and are cheap and high quality, and so happy to own on the sort of Microsoft type of end of it, where the prices have come down and they look good. Then there's that higher risk loss making ones, and really for those it's a bit of a leveraged bet on the rest of the market, in terms of saying, look, when the market's, it's a bit like cryptocurrency in a way. When everyone's talking about, hey, imagining how great things are, and it flips from fear to greed, then they're the stocks that are going to boom the most. But the issue is, it flips back to fear again. They're the stocks that can bust the most as well. And whereas I think some of the more stable ones, we're actually getting the earnings behind it, like your Microsofts and ones like that, and sort of higher quality businesses, then when it flips back to fear, first, they can't fall as far because you've actually got earnings to underpin it. But secondly, you are getting reasonable dividends, and you can sort of see that, oh, well, look, if this stock doesn't recover, and I'm happy to get a dividend that's whatever, 4 or 5%, and just grows every year. It's like, yeah, sure, I'll take that as a return. And then eventually the price will come good. So whereas the stocks that are losing money is actually, well, no, prices fall and people are going to have to tip more money in because they need more capital in order to keep running the business they're running, and they're the dangerous ones, where it's it's a play on the sentiment and things like that, more so than a direct investment call, I think, on those individual stocks.
Yeah, and I'll give you a good example at the moment. AI is flavour of the month, right? And so anything with an AI flavour attachment to it is suddenly perceived to be way more valuable than it was, right? Again, I'm highly sceptical. I'm afraid that judging by the number of emails I get in my inbox at the moment saying, hey, did you know you can double your money if you use this AI? Or, everybody's now going on the AI bandwagon, which suggests to me that actually, whilst there's probably some good stuff in the middle of it, there's a lot of rubbish as well. Yeah,
look, and I mean, I'm going to make a bit of a social commentary on the whole chat GPT as well, because I think there's, I'm assuming most people know what chat GPT is and have probably had a bit of a play with it. It's a very, so I'd been using similar types of things last year and sort of just playing around with some of them, and they're very good at you give it a few bullet points and it comes up and gives you quite coherent articles that it can write. Is that I do think there'll be a proliferation of people who in terms of websites and looking for content, because that sort of it's obviously a big market of people going, I want content to fill my website. Going, write me an article about whatever, the best way to, whatever, fry something, or the best way to make this or cure
The
whatever.
best way to make money on stocks is.
Yeah, that's right. And so those types of ones that are like, okay, just content filler is going to come quickly and easily, and I think that's going to be a proliferation and explosion of those. I'm quite interested in the whole part about saying though, we still need an original thought somewhere, at the heart of this. And so I wonder actually if what we might find is some ideas that actually get propagated faster than they used to, in terms of it being, I write a story which is relatively unique about something, and then all these robots all pick up on my story and reword it and put it on other people's websites. Is that idea might actually find that spreads actually a lot faster, because we've got so many websites, and if they're copying from each other and they're all copying from each other and they're all sort of cheating off each other's homework, you're not getting anything original out of that. It's actually that the actual people sitting at the bottom who are writing originals, maybe they don't get credit for it, but yeah. And then the other thing on, I just saw a comment coming up about ChatGPT and stock markets. So I've seen a lot of stuff on AI and stock markets. I mean, they've been playing for years with it. You can get some fantastic historical returns that, this is what I would have bought, if I got these things. And a lot of that artificial intelligence, a lot of it depends on, there's a whole these different models about how you can train it. And some of them are, it's sort of like this massive data thrown at these models, and the data comes out and you don't actually know why it's doing things. So you're reading this article and it's giving you this article about what the best way to bake a muffin, and you're like, well, I don't know why it's chosen this one and that one, but it has, and it's come out and it's pretty good. In the stock market, it goes, okay, we've just bought all these stocks, and then you're like, well, why have you bought it? And it's like, well, the model, it's pretty hard to tell. And sometimes if you dig back through, and you might find, well, we bought companies starting with the letter A on Tuesdays, and then on Wednesdays we bought companies starting with the letter K, and then we wanted ones with a 3-ticker symbol versus a 4-ticker one, on the third Monday of the week. And you're like, just a minute, all you've done is taken this massive data and backtracked it to completely obscure things to come up with the reasons as to why you've done it. And it's something that isn't going to work going forward. It's sort of all, it's all based on spurious correlations and things that just, aren't going to continue. But the problem is with a lot of these models, you just can't tell from looking at them. You just don't know what they're doing. They're just like, well, if you had have just listened to me, then I would have made you all this money. And you're like, okay, well, great. Now let's turn it on and go forward. And it's it never works. So.
No, well, it's very interesting, because years ago I was involved in capital markets, and you had these black boxes where we had all the inputs and all the outputs, right? But nobody really knew what went on inside the black box. And there were loads of people claiming that they could, outwit the market and make massive returns. Well, they did occasionally, but actually only 50% of the time. The rest of the time they were actually pretty bad. And if you look at the average over a period, actually, it was just an average over a period. So sometimes these high-tech solutions don't necessarily actually meet the, as advertised, right? But there's a lot of hype. There's a lot of people who make a lot of money on the way through because, of course, they're involved in hyping.
Yeah, that's right. So I guess where I see that where artificial intelligence is good is where there is a definitive answer, and you can look at things and say, is this a cat? Is this not a cat? Okay, if I'm driving a car, is that a person walking across the street, or is it not a person walking across the street? Artificial intelligence is very good at learning that, because you can just go, it thinks it was, and you're like, no, you're wrong, or and you can teach it, and it goes, oh, okay, I'll learn from that. Next time I won't make that mistake again. Whereas, stock markets and other factors where it's like, well, something just went up. There could have been 1,000 things that made it go up. Which one was most important, and the one that was most important this time might be completely wrong next time. And so, that's generally the problem. And then the second part obviously is that the whole part about, unfortunately, I think we're going to be in for a lot more written information sort of coming at us from everywhere, because these things can write so much faster. I think a lot of it will be completely useless, and there's no. It'll add nothing to anything except make more noise, but it'll sound good and look good, and so.
So the idea, what you want is an AI to read it. Right?
Yeah, that's right.
So,
Tell me
so
what's
you get one
important.
AI to read it, another AI, and they can just go and talk to each other, and we'll just carry on regardless. Cut out the middleman.
Well, and it reminds me, because we're talking about analyst stuff as well. It sort of reminds me a little bit of the way we deal with that. Is that in the end, what happens in a company. It makes money or does whatever, and then the management gets its accountants to twist everything around and mix it all up and put it in a format that makes them look good. And then as an analyst, you got to take that and try and undo that and get back to that original part about what was really going on. And that sounds like what you're talking there as you're pulling that out.
Now, I think you need to disappear a little early tonight, right?
20 past.
Yeah, okay.
So I've got 15 minutes.
Yeah, good. So let me just sort of move the conversation on then, because obviously next Tuesday the RBA is scheduled to have its meeting.
Yep, and I think we've got the Fed this week, isn't it?
The Fed is
tomorrow night or the night after?
Yeah, I think it's Thursday morning. We hear what the Fed said, and the expectation mostly is that the Fed's going to go 25. We've got the Eurozone a little bit later, a bit later than that. We've got the Bank of England and we've got New Zealand. The retail numbers today were quite weak. So it was down 3.5% in December, which was weaker than expected. On the other hand, the inflation was a lot stronger, 7.8%, and non-discretionary inflation at 8.4%. So most people, I think, not everybody, but most people are saying, yeah, the RBA is going to lift again. Some people are then saying they're going to stop, go sideways or whatever. I'd be interested to get your perspective in terms of how you're reading it, but also how you're reading what other people are seeing. Because to my mind, some of the other stuff that's out there seems a bit nutty to me.
Yeah. So, and I guess the other thing to add in is that jobs have been relatively strong as well.
Yep.
So I guess I just want to take a step back and go, the most lagging indicators we tend to have are jobs and inflation. So they tend to be the very last factor that you get. So when you go into a downturn, the jobs are the last thing to go. So you cut your advertising budget, and then you start getting rid of a few other things, and you don't have as many cakes for your smaller cakes for birthdays and whatever it is, and you eat less, and eventually you go, okay, now things are in trouble. I've actually got to fire somebody, and that sort of tends to be one of the last things. So and then similar on the take up as well. On the other side is that as economies start to take off, you're like, oh, I've got actually things are turning around and we're getting more sales in and all that stuff. Do I want to hire someone? Oh, actually, well, I don't want to hire them if I just have to fire them again. So I'll hold off and wait until I know for sure that yes, I'll make sure everyone's maxed out, and now we absolutely have to get somebody more. And so I guess what I'm coming to from this one is, I look upon those numbers and say, well, that's telling us what was happening 6 months ago or 9 months ago in terms of the factors. Having said that, I think the RBA and central banks are pretty focused on those numbers and need to, and that's, I guess, the direct correlation for them is, okay, jobs were weak, therefore I should be cutting rates, or jobs were strong and therefore I should be raising rates. I do think they're going to keep hiking. Largely because I think the rest of the world has been, and that they sort of feel there's a bit of a groupthink in there. I think they've probably already gone too far, but I don't know when they're going to pull back. I think they'll be certainly getting nervous about some of the data that's coming out in terms of the weaker forward data. But and this is pretty much true of the US as well. But I do think there's a strong enough element within the central banks that's saying we don't want to be. I've just forgotten the guy's name now. Arthur. There was a Fed guy who cut rates too early in the 70s,
70s,
early
absolutely.
80s.
Yeah.
And then let inflation.
We had two bites at inflation because he didn't tap it down the first time. Yeah.
Exactly, and I think the lesson that and then you had Volcker come out, Paul Volcker come out and cause a recession and get rid of inflation, forever, so to speak. And he's looked upon many central bankers as a hero. And so if you're a central banker, do you want to be the guy who cut rates too early and let inflation get going again, or do you want to be the hero that conquered inflation? and I think there is a predisposition for central bankers to be only the hero, and regardless of whether the situation then is warrants the same result, the same reaction as the situation now. And so, yeah, I do think they've gone too far already. I think we are headed for a recession. Maybe something will come out of left field and surprise us and help us out, but I think the odds are against it. So,
and did you say today the new head of APRA was actually reported, I think, in the Australian as saying, well, if necessary, we can always reduce the interest rate buffer on mortgages.
Right. Yeah, good. Yeah, we're going into a downturn. Let's let more people borrow more money.
Exactly. What could possibly go wrong?
Yeah,
but it's just reflecting, this is the Roy Morgan stress data, which came out the other day and was significantly higher, right? So they're saying 1.1 million households in mortgage stress on their definition. Mine's a bit higher. And we do know a lot of households are actually, really struggling at the moment. So there's definitely some nervousness within some halls within the RBA about what's happening. That's quite clear. But I do agree with you that the biggest concern they have is that they actually let the inflation genie stay out the bottle too long. They would prefer to put the rates up a bit higher and keep them higher for longer to make sure that they actually do deal with inflation. Now, whether in fact lifting interest rates is the best way to deal with inflation, particularly when the inflation was triggered partly by their quantitative easing earlier on, and then by the
pandemic and
Ukraine,
supply chains,
etc. Yeah, it's an interesting question in its own right. But
and the issue, some of the things that we've seen some weakening in terms of inflation numbers in the US for the energy prices have come off. Oil prices have come off specifically. We've also seen the gas prices have tanked. We've seen used cars starting to roll over. We've seen what else? Housing prices. These are all the ones that, as on food prices. Sorry, food prices are certainly falling away. These are the ones which the Fed doesn't really control. Like it's the arguably the ones it wants is the services type ones are the ones which it can sort of push up and down a bit more. They're the ones that haven't really moved that much yet. Yep. So.
But the wages in the services sector, particularly in the US, have moved up quite strongly. And interesting, in the producer prices data from the ABS the other day, there were some big moves. If you think of the value add at each stage on the production cycle, right? A lot of those were putting price is up quite considerably. That has to still flow through. So I don't think that inflation is naturally going to drop as quickly as many people say. I mean, I know there's some base effects there, but I think there are other forces at work, and the wages stuff, despite the fact that, of course, in real terms, wages are still going backwards.
Yeah, well, the wages will be interesting. In the US, they've obviously been running stronger. In Australia, we really haven't had wages grow. Well, they not really haven't, but they haven't grown at any particular strong rate. I mean, they're
going backwards in real terms.
Yeah, and we've just opened the floodgates to more students and all that sort of stuff, and so they're unlikely to get going. It does seem a bit strange in that. Not strange, but it's one of the peculiarities of the central banking system, particularly in Australia, is that they're congratulating themselves on keeping wages low.
I know.
And they're saying, well, just a minute, isn't the goal here is that we're meant to be sort of advancing our economy? And it's like, well, we've got corporate profits have been fantastic, Martin. So that's been great. But wages, we managed to keep a lid on wages because that keeps corporate profits high. And you're like, oh, sorry, is that really what you're meant to be doing?
Yeah, well, wages constraints is not a bug. It's a feature of the way the economy was actually working for quite a long period of time. And by the way, people at the Reserve Bank, I believe, got more than 4% this last year in terms of pay rises.
All right.
Don't do as I do as I say, right?
Yes. Well, yeah. Well, anyway. Well, did the unionised workforce get that as well? They were the ones getting. Sure. They were the ones copying it, weren't they?
Yeah, exactly.
Anyway, but let's not.
We won't go down that rabbit hole. But look, in the last 2 or 3 minutes before you disappear. Okay. So thoughts in terms of portfolio, right? How are you thinking about it now? And you've always said, I'm thinking about plan A, but I also think about plan B, because plan A might not work if something goes the wrong way. So how are you balancing these countervailing forces?
Yeah, that's right. So, okay, just before Christmas, I flipped a bit, bought a bit more equities, mainly Aussie stuff, and you reduced underweights to resources just because this whole China reopening. It's like, okay, well, I'm not going to stand in the way for that train. You can see that's where that's running. I think that's coming to the point where, and when I say I bought some more, it's not like, it's like 5% more or something like that. We're not sort of swinging massive swings in the portfolio. It's more just around the edges. We're still very underweight equities overall. Lots of cash, lots of bonds. The issue, I guess, I'm looking at now is saying, okay, markets have run up. Okay, so now I'm starting to reverse on those ones and take the top back off them. The issue I've got going forward is I'm either right on the earnings, and so there's quite considerable market downside, or I'm wrong on the earnings, and maybe markets can just keep running from here. And maybe we're in a trading range. We'll go up 5 or 10%, and it could fall back, and profits will keep growing. And in a few years' time, you won't sort of care that you paid a little bit more today. I think that second scenario is unlikely, but I'm aware it might happen. And so, and I think there's enough just weird stuff going on with data all over the place, where some stuff's booming and other stuff's busting, and there's just you're looking at data and here's something that's down 30%, and here's something that's up 30%, and that's base effects, and it's all these other things going. So I guess I'm as attentive as I've ever been to trying to work out, am I wrong? I think we are headed for a recession. I do think there's profits will get hit quite substantially, but I'm looking as carefully as I ever have in case I've got that wrong. And when I'm not completely out of the market, we're quite underweight. We've got lots of cash if things do fall back to buy things, but it's that balancing act of, I think things are very uncertain, and we need to be sort of looking everywhere we can for more information.
Yeah, absolutely. Yeah, you paused for a second, then came back just at the time when you said you were uncertain. So that was quite funny, really.
Oh, okay, right. I heard a beep and I wasn't quite sure what was happening.
No, I don't know what it was, but anyway, so that's good. Well, look, I want to say thank you very much. I really appreciate your time once again, Damien. And as always, the World Funds powered by Nucleus Wealth is worth exploring if people want to get some thoughts about that core investment, not the periphery, not the the flowery stuff around this, but core investments. That's what you guys do.
Yeah, that's right. So you want center of your portfolio, regardless of whether it's with us or whoever it's with, you want highly liquid, high quality assets to sit in that core of your portfolio. So blue chip shares, government bonds, cash, international Aussie shares, things like that. Then around that, now you can, you want to buy some hedge funds, you want to buy small cap equities, you've got some particular stocks you want to be exposed to, you want corporate debt, whatever it is, do that around the edges. But you should have that core in the middle of those high quality assets, because they're the ones that are going to give you the diversification. They're going to give you those returns over the long term, and then they're the ones when crises happen, you can actually sell those, and get to that liquidity if you need it. So for some people, that's 70, 80, 90, 100% of their portfolio. For other people, it's it's a smaller amount, and they've got lots of these ones around the edges, and they're happy to have a broader perspective. But you need something in that core, and that's what we do, and love to help people with give us a call or sign up, and we can talk through.
Yeah, so links and things below, and it's such a transparent process, and very important to have that concentration at the core. Thank you, Damien. I really appreciate it. We'll catch up again in a month's time and see where things have gone then in this great world of uncertainty. So I really appreciate your time tonight. I'm going to take you offline now, so you run away. Thank you very much. See ya.
See ya.
Okay, so we've got a few minutes left just before the show finishes for me. Somebody asked a question earlier on, which I want to pick up, because they asked the question about what happens when you've actually paid off your mortgage, but the deeds are still kept with the bank? That's a very good question, and a number of people do keep their deeds with the bank, even though they don't owe any money. And one observation is that it's costs you a little bit sometimes to get your deeds back, and people don't necessarily want to pay that. The second is that some people find that subsequently they want to go and then borrow some more, and the deed's already at the bank, so it's cheaper to do that. But the other question, sometimes people are a bit worried about, well, does that give the bank some lien over the property? And the truth is, if you don't have a financial obligation to the bank relating to that particular debt, then really they don't have a lien. My own view was always, though, it's nice to get the bank off the deeds completely, rather than actually going down to zero, unless you think you're going to borrow again, in the immediate term. So there were a few savings by doing it. Some people do it because they just don't think about it. And I remember somebody I was talking to the other day who actually discovered that the bank had been sitting in as effectively as a zero owner of their property for 10 years, and then when they went to sell, they had to get them off. So it can be a bit of a barrier, so it's worth just sort of thinking it through. So there you go. Jason, thank you for that comment there. Appreciate the viewpoints, appreciate all the views. Yep. Stay well, everyone. Hopefully we'll see you next time. Yeah, let's hope so, that too. My own perspective on the RBA is they will raise next Tuesday. They'll probably do one or two more. And I think the markets are overestimating the fall. I think we're going to see rates staying quite high. I do expect APRA to reduce the 3% buffer at some point quite soon to try and give people a little leeway. And all of those things I think will come through. And interestingly, tomorrow I'm interviewing the guy who's started publishing the maps showing property price moves. So we do the Andy Spruik videos with the Cookie Boys' help, but I'm interviewing the guy who has been publishing these maps, and that video will come up in a day or two, which should be quite interesting. I thought we were talking about that. And I should tell you that next week it's me, and I'll be talking about the latest with regard to households, stress, and the property scenarios. The story there is that there's a lot to talk about because things are moving quite quickly, and we're going to do some of that. And Cookie Boy said next Andy Spruik video will be on. Well, we've got the Mandra data that you did a little while ago, Cookie, but that's probably worth doing. But there's a whole lot of Brisbane stuff that I want to look at. And in fact, in a couple of weeks' time, I'm going to have Megan Wells on because I want to discuss in detail the price falls in Brisbane. CoreLogic came out and said that they're actually the fastest price falls ever in Australia, which is quite interesting. So it will be quite interesting to see how that plays out. And then the other thing is, I think this Friday I'll be hopefully chatting with Tarek again and getting his perspective on the various rate rises that are happening later in the week. Anyway, I'm going to close it a little early tonight, so thank you very much for spending some time this evening. Thanks again to Damien for his time. Hope you enjoyed the conversation. Thanks for all the questions. Thanks for the super chats. And we'll be back next week. Meantime, check out our other shows. Check out our shorts. We've been doing a few of those. And I would say, if you've not seen the short clip that I did today, where I took part of our rant with Edwin and focused in specifically on this property that had this massive extension at the back that was uncertified. And we discussed that because it's quite a salutary warning for anybody thinking about buying property at the moment. So if you haven't seen that, go look at that. Thank you very much. Have a good evening. Keep safe. And we'll be back next week. And just before we go, of course, we should just visit the doggies. Sound asleep, haven't moved. They've just been pretty much there the whole of the evening. So there we are. Thanks very much. Take care. We'll see you next week. This is Martin North from Digital Finance Analytics, signing off. Good night.